Hey, good morning. O'clock, and we'll get this party started here shortly. A couple people typically, slowly log in. So I'm going to go ahead and share my screen so we can kind of look see what current interest rates are doing right now. And all right. Slow connection today. There we go. All right, everybody. So I'm going to go ahead and slowly get started here. And first off, thank you guys for being here this morning. Happy Monday. It's the start of a typical business week, but we don't really have typical business weeks. So it's just another day to us. But I want to kind of get into the kind of what's happening with the markets, what interest rates are doing, and then we'll go into the forbearance, kind of what's happening, what to expect, and how can you guys set yourself up for success with potential customers that may need assistance with the forbearance, whether it means listing properties or just help coaching them through the process. So we'll get into that secondary. But excuse me, to start, let's go to kind of see what interest rates are doing. Like I said last time, we're in a trend that's basically upward in the bond market. I think I'm sharing my screen, right? I think yes. So you can see the upward trend, this green line that I drew that kind of shows where we're at. Today, we're in this little red dot right here. So we opened up actually better than where we're at today. We're up 3 basis points, but since 9:30 this morning, we're actually down a total of 5. So we're positive compared to where we were closed on Friday. But as you can see, the bond markets are just kind of in this upward trend. Remember, it never goes in a straight line. It's always like a heartbeat in the specific direction that we're going. So if we look at the overall trend, rates are getting better. So you probably heard of all the different refi companies out there blasting rates are better, they're getting better, or you've probably seen that everywhere. Yeah, we just went to positive 5 right there. It is true. It's not in huge swings, but it is gradually getting better since June 14th. So that's 45 days. That's what it has taken to gain about 200 basis points. So basically a rate today is 2 points better in discount points than what it was back in June. So in June, you would have to pay 2 points to get the same rate that's being delivered roughly today. So that's kind of where we're at in regards to interest rates. I want to show you a national average right here so you can kind of see where we are at. Daily mortgage rate survey. And again, this is Mortgage News Daily, which I think is a great website to go to for current real estate information. If you want to share things on your social media, they have really good information in here. But here's the daily rate survey. 30-year fixed right at the 2.875 range. You can get cheaper. You just have to pay for it. 15-year 2.32. Again, you can get cheaper. You just have to pay for it. And the opposite is true as well. If you're on that class or that meeting, so to speak, where I showed how to pay for closing costs through the rate. A rate in the high or in the lower 3s may give you a lender credit to pay for closing costs. So that's the national average. That's where interest rates are right now. We do have some big information coming out. We have jobs numbers coming out. We have this week we've got inflation numbers coming out. The Feds are actually meeting today based on some strategies that they're going to be taking. So it's going to be an interesting week kind of see what rates are going to do. But for right now, they are following the trend, which I had not predicted, but it's it's easy to kind of show what's happening in the markets just by economic activity, but we're still on that trend line. So we have above this blue line right here is a 200-day moving average. We broke through it, but those are really big ceilings of resistance, and we bounced back to, look at that. Isn't that miraculous how it just stopped?
Okay. Sean's Monday mortgage thing is normally pretty good.
So we're seeing a little trend here for the better for interest rates, so that's always a good thing. So if anyone's asking what's happening with interest rates, you can give them a pretty solid account of what is happening. Now, there are some people that are showing that the 10-year, I'm going to jump into this model real fast, the 10-year is going to hit 100 or even below 100. So we dipped down to the 1.13 on the 10-year, and then we kind of bounced up. Now we're in between this, what I call a sandwich. We're in between these levels of resistance. We tried to break through it this morning, but we're kind of stuck right there. If we break through this, we'll go downward towards the 1% mark. And it's been predicted that if the numbers continue, the longer term is we will be below 100. It may not go in a straight line, but that is where the trend should be. And then interest rates should go even lower from there, from where we are today, if that does happen. So as you can see, this trend line is very similar to the 30-year fixed, as far as this is going downward, whereas the 30-year Fannie Mae 30-year note was upward. They have an inverse relationship on rates. Anytime you see the 10-year going down, rates for the 30-year go down. So it's a good little, those kind of work together. The Fannie Mae 30-year bond is the one that the higher the value, the lower the rate. So just a little FYI there. So a lot of other interesting information to kind of go over what's kind of happening in the markets. A really, I guess you can call it strange account. The new builds, the construction, the brand new homes that are being constructed right now and sold by new builds actually went down 6.6%. And there's a lot of builders that are actually slowing down their selling of homes because they can't keep up with the demand. So they're just putting things on pause. So as an example, DR Horton is cutting back. Their reason was supply chain, and they just have a backlog. They've sold more homes than they can produce, and they don't want to oversell and then not be able to deliver on the homes that they are trying to build. So a really interesting phenomenon there, where builders want to build, but they can't do it fast enough to handle all of the amount of demand that is on them. So they're actually slowing down because they've sold too many to this point, which is really strange and really interesting. I wish they could build more and more quickly, but as we know, the supply chain is still hurting. Intel came out. The CEO of Intel last week spoke, and he is predicting the chip shortage to continue through 2023. So the chip shortage is hurting a lot of the different companies that require those. Utilities for home, appliances for homes, like the smart kitchen appliances, like the washers and dryers, all of those that would require chips, cars, all of those that require chips. Anything that requires a chip is going to have issues being slow to the market until 2023, according to the CEO of Intel. So just really interesting to see how those, ignore that, how those chip inventory has such an impact on everything else. Now, some other things, I've mentioned this before, institutional investors, that's big corporations like BlackRock and others. You'll be blown away by this stat. In the second quarter of this year, institutional investors purchased 67,943 single-family homes and turned them into rentals. In quarter one, the institutional investors bought 59,000 homes. So that's a combination of a total of 86 billion in real estate that was gobbled up by investors that are institutional investors. That's not you and I buying in rental properties. That is institutional investors buying properties and turning them into rentals. So that single family owner occupied, that amount of homes that is out there is shrinking because of this. So just interesting. We've seen that kind of get bigger and bigger, and that, by just to let you know, that's a record. That's the highest figure on record for the amount of homes being purchased by these corporations and these BlackRock, these private or corporate institutional investors. So that's why we see competition out there. It's hard, but keep at it because it will get better as more homes come onto the market. And that's where we want to dive into the forbearance. So Friday, there was a new HUD issued a new letter, and I actually put it in this chat. So there is a document in there that HUD issued. If you look at the chat screen, now I'm going to stop sharing for just a second, and I'm going to go into that chat. It's the HUD.pdf. Now that's their announcement on what they're doing, and this is FHA and what they're doing to help government insured loans through the forbearance. So they're coming out and they're going to extend it through September for those that are open to needing a forbearance.
I don't have a link.
So the forbearance rules and that are out there in the forbearance timelines for conventional was supposed to be through the end of July. So we're supposed to see what this wave of foreclosures that they talk about coming August. And I want to go over that because this is very important for your marketing to know kind of who to target and who to call and who to follow up on. Maybe do an annual real estate check-in or update for your past customers. But for Fannie Mae loans, if they are in forbearance, supposedly, and they may follow HUD on this, on the extension again, but supposedly next month, those will be coming to market. And they're going to come to the market in the form of being a recorded notice of default. So now lenders can actually post a notice of default. And then that process of a foreclosure could take place. But I want to kind of go over what's going to happen, because there's about 1 million people that are in forbearance right now. And that number keeps shrinking. Of that, 40 to 50% are in a payment plan already. So only about half of those people that are in it, let's just say 500,000 roughly for now, are truly in a position where they may not be able to afford it, or they have not initiated a payment plan or a resolution to their forbearance. Now, some of the things they can do a loan modification. Now, these are the things I want you guys to write down, and I'll give you the notes on this as well. But they can do a loan modification where they can get a reduction in their payments of up to 25%. So they can go in and talk to their servicer and get a reduction of up to 25% on their payment. A lot of times that is a interest rate reduction. It's over a new 30-year loan. It's a loan modification. So that is someone that you have to qualify for it. It's not just automatically given, but that is one of the steps that they can take. Another one is what's called the standalone partial claim. And that's where if you've suspended your payments for, let's just say 12 months, all of those payments can then be put as a second lien on your property. And that lien is 0% interest, and it's paid off anytime you will do a future sale or refinance. So I want you guys to just focus on the fact right now that there's only about 500,000 people left in this that are really hurting. That number may fluctuate, but FHA and the lower income are really where you're going to see a substantial impact. No, I wouldn't say impact, or the numbers are substantial in that group. So anyone under that 400,000 value property is more susceptible to having it, because unfortunately COVID hit the service industry much harder than it did the other industries like the professionals. So we're seeing a lot of those lower income individuals being hurt more. So we will see these hit the markets in one way or another. So how can you take advantage of this? Not take advantage of, that's a bad word for it. how can you help your customers through this if they are in need, or if they are in forbearance, how can you coach them through it? Well, I highly recommend you reach out to everybody. Maybe you can do an email blast. I highly recommend calls, looking at them. Anyone that's in an FHA loan has a higher risk than a traditional conventional loan. But most of these people that are in forbearance right now, they've also had a very nice gift, and that's a very big appreciation factor for the last 24 months. So most of these people have enough in there to absorb any issues without going upside down, but lenders are starting to prepare their short sale divisions. Now, I don't think there's going to be a ton of these, but let's just think about it for a second. If somebody bought an FHA loan a year and a half, or at home with an FHA loan a year and a half ago, and then immediately went into forbearance, even if their property appreciated 10%, that's 30 grand. If they missed 10 payments, 12 payments, that's going to have a pretty big impact on that. And if they sold with commissions of 6% reducted from that, or reduced from that, they could be in a position to do a short sale. So what we need to do is be proactive here. We need to call our customers that we've had and they've closed in the last 3 years in an FHA loan, 2 to 3 years, and all of those that you may know that may be in a tough position with their equity, to have those conversations with them, because most of these properties will be listings. Now, here's an interesting stat. If, let's just say, a third of the homes that are currently in forbearance that are not set up on a payment plan, so those are people that may not be able to afford it. If a third of those went into default and then were listed yesterday, that would just give us 10 days of additional supply. That's it. That's not very much. We're not going to see this wave like a lot of people are panicking about. So if only a third of the homes hit the market, if all of them hit the market at once, let's just say 500,000 homes hit the market at once, keep in mind we are already 33% lower in our total number of homes on the market than normal. So if that number hit, we would go to, instead of 1 million homes in the market or so, or actually, I'm sorry, we're a lot less than that. We would hit about what the average is, and it would only increase the days supply by 24 days. So even if all of them hit at once, those that are not in payment plans or not set up and already had the loan modifications created, it wouldn't add very many homes to the market where it would impact it to have what's called a bubble. So let's go backwards for a little bit. The bubble that we had in 2008, 9, 10, that timeline, there was over 3 million homes listed at once in the United States. The average is 1 million. So it was 3 times, and it was probably more than that if you factor in the population growth now, the ratios, but it would be a bigger number than that. You have to have significantly more homes on the market than buyers in order to have a bubble. We do not have that. We have the opposite of that. So let's think about this. When we talk to these people, call them. Please reach out to everyone you know to talk about this. It's a great talking point. You can alleviate a lot of stress, and you may get a listing out of it. Call them, go over their circumstance, see if COVID did impact them, reach out to them and talk to them about the market, because if they're able to persevere and move forward, they'll be better off instead of selling. Even though you could help them and get a listing, everyone has their own circumstances. But if they can push through, they may be better off, because trying to buy in the future, I believe, and all the numbers show, that we're going to continue to have appreciation. And it's the reason I say that is, well, supply and demand. If builders are slowing down and if rates stay low, there's always going to be a buyer's market. And if there's not enough homes that people don't want to leave because they're already settled, or there's just not enough inventory and it stays this way, it's going to be a supply and demand issue, because a lot of people got really low interest rates the last couple of years, and especially this last, like a year ago from now. And if rates go up, which I don't think they will, but if they go up 2 or 3 years from now, which they may that in that timeline, nobody's going to want to list their properties for sale because they have these great rates. They won't want to move. They won't be more enticed to move. In a low interest rate environment, people are enticed to move because their money will make them get a bigger and better house because of the lower rates. So when you're talking to these people, make sure you reiterate that we don't think this is a bubble. The only way it could be a bubble is to watch the inventory. If inventory spikes out of control, then that would be an issue, but no signs show that. There's nothing out there showing that these are the amount of homes listed is going to spike to a tremendous amount that is unsustainable for the amount of buyers that we have out here. So we still have a very high amount of people looking for homes. Every one of you know that you're still getting multiple offers, and you need to be. Hold on one second. Let me see who that is. I can mute them real quick. Make sure you're muted, guys.
I'm trying to get a price on some.
Don, I think.
Yeah, who is it? I'm trying to find who it is. Okay, no worries. All right, we're good now. So I wanted to make sure that we all know that the inventory is at a point where there can't be a bubble right now. Now, we don't know what it's going to look like 24 months down the road, but we know what the next 6 to 12 months will look like because the wave that everyone was predicting isn't very big. Most people are going to do payment programs. And remember, they can just take, most services are just going to take those suspended payments and add it as a 0% mortgage, as a second mortgage with no payments due. So there's a lot of good things that the lenders are going to be doing to help people in these situations, as long as they can continue making their normal payments. And if they can't take their more normal payments, there are loan modifications being done. And then there are that 25% decrease in payment is available if you qualify. So the wave is a trickle. It's going to be absorbed. We just need to make sure people understand this because there's a lot of misinformation out there. As you know, I'm starting a, you might not know this, but I'm starting a TikTok channel called Mortgage Ninja. And I'm going to be creating these cute little videos to like help give proper information out there because there's so much bad stuff out there. I listened to one where the guy said it was going to be a worse housing bubble than 2008. And there was no data to back it other than the forbearance. And he didn't really understand the forbearance or the details regarding that. So there's just a lot of bad stuff out there. So watch out for my Mortgage Ninja out there. I'm going to be giving you a lot of tips and a lot of good stuff out there. So now I want to kind of focus on the forbearance and how we can help. So when lenders are able to actually show and record that these mortgages are late, then we're going to start seeing notice of defaults with the county, and that's where those records become available. And at that point, you can probably market those, and my wonderful partners at Pioneer Title can help you maybe with getting data on that, but that might be too late. That's why I want you guys to reach out now. Make sure you're posting to social media about, do you know the options available if you are in a forbearance and what's going to happen, and make sure they understand that yes, there are some people that will go through foreclosures, but if all of those hit the market, it would only increase our marketplace or the days on market by 24 days. That's how badly we need the inventory. You all know it. Trying to find homes for people is very difficult. And also some misinformation. You'll see numbers that like our median sales price rose by 23% this year. I want you to make sure you understand median home price versus appreciation. Appreciation is how much homes are increasing in value. Median home price is the average home price that is selling. It has nothing to do with appreciation. So when you see these numbers on median home price, people get it wrong. Make sure that your people understand That is just because the jumbo and the luxury market exploded this last 2 years. The number of homes that are going under contract above $1 million is significantly higher than the normal. And that's why we see this median sales price inching up. And that's why you see that being so high. So make sure you understand that as well. Understand that builders are slowing down. That can't help with our inventory problem. There's going to continue to be more demand than the supply because of that. The supply chain with wood is still an issue. We don't have a lack of wood. We have a lack of wood getting to the proper spaces right now. If you look at a lot of the lumber yards, they're full of wood. There's a lot out there. So the inflationary pressure of the wood should come back down because it's not a supply issue. It's getting it to the end user. So you'll see that. So there's a lot of things that are for the positive as far as the real estate market, as far as values. So make sure your people know and understand why. Now I'm going to go through these questions real fast. There's quite a few of them. Do the institutional investors stay at certain price points? They do. Usually these are in the more, I would say between the 2 and the 6 range, in the properties that fit more of the lower income or those that have a higher population of rents. So you're going to see them gobble up all of those, and they've been doing it for a long time. So I would say anything 600 or less, you'll see those institutional investors in that pond, so to speak. Please resend PDF link. It should be above. So if you guys scroll to the top, there's a PDF link. I will resend it to everybody on this call as well in a follow-up to this meeting. Let's see here. Let's see. Measures, please resend. My knowledge of median is middle, not average. Yes, that is correct. So the middle of the homes being sold, the price point in the median of that being sold, it has nothing to do with appreciation. So there you go. You're exactly right. Any questions regarding forbearance? I do want to go into a few things if you guys have those. Follow-up is probably the biggest thing that as a real estate community we don't do. And when I say follow-up, I mean once a house closes, once you close on a sale, once you close on a buy, what you do after closing, I think shows more of your character than what you do during. We're supposed to do all of that during because that's what we get paid to do. But what you do afterwards will help solidify those relationships. So I put together 2 different PDFs here. One is a 90-day post-close for sellers. The other is a 90-day post-close for buyers. And that's if you have a buyer and you sold and closed, or if you had a seller and you listed it and sold it and closed. These are a few things that you can do, and I'll share it with you real fast just to kind of give you an idea of what this looks like. Hold on, let me share my screen. All right, so there's a list. It's called a 90-day post-close. It's part of, this is a little bit of a sneak peek into what Aaron Hodson offers. So if you like this kind of stuff, definitely you need to be in our coaching with Aaron Hodson. So these are scripts, which I don't like, but it's just more of a guideline, a guide, so to speak, on what to say when you are emailing and calling these people. There's a 3 days after close, 7 days after close, an email, a phone, 14 days after close, and it goes all the way on, and it goes all the way through for a 90-day close period. So emails and phone calls, put these on your calendar, set them up to be automatic every time you have a closing, because what you do after will solidify those relationships, and that's where you're going to get the referrals. So utilize this, save this, and I'll send this to you as well. But you can learn about this and thousands more tips and tricks through the coaching series that we have with Aaron Hodson. And if you guys know Aaron, there's a lot you can gain from him. So I'm going to open up the chat again. If you guys have any questions regarding what we went over today, if you have any buyers that are in forbearance that want me to talk to them about their options, I'd be happy to do so. However, I highly recommend they call their current servicer, because every servicer of their mortgage will handle things a little differently. And don't forget, SunWest Mortgage, we do not sell our loans. So every loan that we close, unless it's jumbo, every loan that we close, we are the servicer. So I can answer those questions for all of our past customers. Another fun thing about home mortgage company. All right, so I'm stopping the share. I'm jumping into questions if you guys have any. I will stay on here for the next 10 to 15 minutes if you guys have any further questions on this. There are a lot of things that I can help with your customers if you want me to jump in if they have forbearance questions, and try to hopefully get them to use you if they're listing it, and act as a partner in that for you. So definitely reach out to all your people, guys. Make sure they understand what's going to happen, and that they may kick this can down the road and offer forbearance for as long as they want. Who knows? But right now it's set as of August 1st on conventional loans that they will start stopping the initial forbearance being offered. So just want to make sure you guys understand that. Any questions? Can we get more information about that coaching series? Yes, I will get that out to you. I will email that out to everybody. Aaron is free. He does have all of his information that he puts together in one format. If you wanted to buy it, it's not a monthly charge. So we can go over that in detail, but we do hold classes in person or via Zoom in my office with him to kind of go over everything that is part of that system. And there's no cost for those classes. So yes, there is if you wanted to get what's called his Sell Well program, which is every tool he's ever used in real estate. Let's see here, Vicky. Yes. Reach out to me. Got it. Send us your TikTok username. Yes, TikTok username is Mortgage Ninja. So I'm gonna put that in there for everybody. I don't have any videos yet, but they're gonna be coming in the next couple days, and there'll be a lot of them. So it's gonna be a lot of fun. I like having fun. I love having fun. So you guys know about that if you already know me. I'm kind of a goofball at heart, but I am a mortgage nerd. So, all right, any questions? I will stick around for the next 10 to 15 minutes. So some good news with rates, they're staying low. And I think it's good news for values as well. People ask me all the time what I think the future will hold for appreciation. I do think we will hit a slow point where we won't see very much appreciation, maybe even no appreciation for a year or two. We might be feeling the appreciation now from the future, but I still think a 2 to 3% clip is going to be normal, and it should be there. Right now, we're just getting a lot of it. And if you want my theory on that, ask me about the anthill theory, and I'll explain that to you a little bit later. But all right, I will stay around. So if you guys have any questions, I will be here. And again, if you guys, some tools, some tips, some tools, just so you know, I still have the buy versus rent projections, bid over ask reports, cost of waiting reports, real estate report cards. We offer home bought list reports, and a whole bunch of other stuff. So if you have any questions on what tools we offer, don't be shy. And yes, we all need to get on TikTok, Christy. But the good TikTok, don't follow all those weird things.
Thank you, Sean. Let us know when you're when you've uploaded your videos. So I'm on TikTok, but I rarely. But
You got it. I'll let you know for sure.
All right. Thank you.
Yeah.
Have a good
You
week.
got it. You got it. Have a great one.
Bye-bye.
Thanks, Valerie.
Hey, Sean, it's Rebecca.
Hey, Rebecca, how are you?
Good. Hey, I might just not be knowing how to do this, but that document that you showed, the follow-up document,
Yeah.
PDF, how do I find that out here? Or are you going to email that to us?
So if you go, at the bottom, there's a chat bubble. If you click on that chat bubble, there's a little conversation log that pops up.
Hang
Scroll
on.
all the way to the top and then click on those links. There's 3 of them.
Not seeing a bubble, so hang on, let me
Expand the view of your Zoom, and then put your mouse towards the bottom of the screen.
Yep, I see a chat with a little a bubble. Okay,
Click
now
on that.
I clicked on it and everybody shows up.
Now click on that and then scroll to the top of the comments.
Hang on. I don't want to keep anybody else, so, well, I see them all, but I'm not seeing that, okay. I
It should
see
be
all
the
the
vi-
comments, but I'm not seeing any.
Oh, interesting. I will send that to everybody.
Okay,
So
I'm sorry, it's
no,
may
that's
just
okay.
be me, but I'm not seeing it, so.
You know, what, I think it may be based on what time you join the call as well. I'm not sure.
was
So
5
let me
minutes
make sure. I'll make sure that's sent out to you.
Okay, thanks a lot, I
You got it.
appreciate it,
Not a problem at all.
thanks.
All right, so I was late and didn't get it. Okay, so I'll make sure everyone has that. Will you go over the anthill theory today for those who stick around? Yes. So give me a second on that. And okay, so the anthill theory. This is my own theory, and I like analogies. I think they're really easy to picture when you have an analogy. It's really easy to kind of orchestrate as well and communicate. So I think picture the entire real estate industry, the real estate world, as this giant anthill that was created, and it was been built for 100 years. Let's just say that. And there's all these different tunnels, there's all these different sections of the anthill. Everyone has their own quadrant they live in, and they're all doing their own business in these very concrete built, very well. It's a great infrastructure, this big anthill. COVID was a big bully that came out and kicked the anthill and poured water all over it. So everyone that was used to where they lived, everything that was associated with it, whether it was economically, politically, whatever it was, changed in an instant. And then things got kind of crazy, and everyone moved around like ants scattering around an anthill trying to find a new place to call home. And they really moved all around the country. We had things like working from home become normal. So now you see that these bigger areas like the downtowns that people paid a premium to be at because they had to be in the office, you see a lot of people moving away from those places to those areas they scattered, whether it meant they wanted more room, they didn't want to have to share an elevator with people every day that had sicknesses or illnesses or COVID, whatever it might be. So they scattered, everyone scattered. And now the last 6 to 12 months, we're putting our roots down in different areas. We're recreating our anthill, so to speak. But we have all learned to live like this, to live with Zoom. We've all learned to work from home. We've all learned this. So the appreciation levels and the values of different markets shifted because of this. So you're seeing California properties in the downtown areas, and you look at these condos, especially in New York now, there's price reductions happening like crazy in these high-rise type living in the downtown areas that used to be paid as a premium for. Now there's some that are luxury, that market didn't really get affected, but the other ones, you're seeing a major shift, and you're seeing values in Arizona creep up to levels that we've never seen. And people are like, wow, the prices here are so much more similar now to what other markets are that have downtown areas like San Francisco. Now we're never going to meet that, but we're gaining ground. And that shift is going to bring, I think, markets like us upward quickly. We're never going to get to that because that's just the way it is. I mean, if properties were $1,000 a square foot here, it'd be kind of crazy. But there are markets that obviously will continue to be higher than ours. But that shift is happening, and that whole anthill theory, everyone running around, scattering and finding new routes, I think is still happening. People are still moving. It's just a little bit slower now, but they're still doing. Now those ants that maybe weren't financially set, they're still scattering around trying to find a morsel to land on, or they're trying to find a house because they either don't have the money, they don't have big down payments. They're still out there, and that's a big market right now. So that's the second wave of buyers that's going to be coming through once things start to slow. Don't forget about those people that were first-time home buyers that were around a year ago that couldn't compete, or even now that couldn't compete with big down payments. They will be there. Those rents that they put leases on for 12 months, they're coming up quick. Do not forget about them. Make sure you're calling on them. Make sure you have a drip system. Make sure you're reaching out with them, letting them know that the market's still positive and that now there may be more open ways of getting into properties as the competition goes lower. Now they will compete against each other. You're going to have maybe more offers with down payment assistance come in, but there still will be multiple offers, I believe. I just think that the money, unless these corporations continue to be on the prowl and these institutional, but it will have a time where they can enter back in. that's why I honestly believe that we're going to be in a good market to help buyers for quite some time. It's just going to be a lot more difficult. Also on that note, Chenoa, the DPA program, lowered their credit score requirements to 600 about a week or so ago. So not all lenders will allow this because they have overlays, but we don't have any credit score requirements here for FHA or VA loans. So Chenoa, pretty nice little caveat. They also are the most flexible of all of the down payment assistance programs. They've got a number of different options. A lot of people are doing more first-time homebuyer seminars. Keep in mind, guys, the baby boomers was the biggest generation, while the millennials are larger. And the millennials are now starting to buy. They have been buying for a couple of years now. They are the biggest buyer pool out there right now. So that's another way I know that there's going to continue to be more buyers than there are people wanting to sell. And if builders are actually buying homes to rent. It's crazy. Just Google build to rent and you'll see all the builders that are doing it. And we have our institutional investors buying homes to rent. I believe that owning a home 10 years down the road is going to be different than people that own homes now. It's going to be looked at as much more of a luxury item or a how did you do that type of a scenario, because the buyers right now have money. And a lot of those people are going to be renting. And if appreciation continues to be driven up because of supply and demand, a lot of those will be taken out of the buyer pool. So encourage people to get in now while it is still affordable, while rates are still low, if they're going to stay low for at least a year or two. Because I believe we do have a recessionary period economically coming. Not a bad thing. It's just a slower economy. It's still growing, just growing slower. So remember, 3 months in a row of negative growth or less growth means a recession. It just kind of means we're going downward. So it's not a bad word. It has a connotation of being a bad word, but it's not. All right, I'm going to jump into the chat. Hopefully that was a good analogy and not cheesy, too cheesy, but I think analogies work.
Hey guys, too, if you're on the call and I just see your first name, make sure that I see Tracy, you wanted the links. If I can just get your last name and your email, that would be great. I sent you a private message too on there.
All right, well, I'll stay on here. And
Thanks again, Sean. I'm dropping off. Thank
you
you
got,
so much.
I'm gonna put the link in here to one of the, well, I'll just send it to everybody.
Okay.
It's a lot easier that way.
Thanks again.
My pleasure. You have a wonderful day and have a great week.
Sean, how's the mortgage supply for vacant land right now?
Vacant land loans are not a loan type that is offered by VA, FHA, or by Fannie or Freddie. They're just not offered.
Sure.
It's not part of their suite. So the only lenders that are out there are private. Banks and private money. It's the only option. So that's why nobody has them, because Fannie, Freddie, VA, and FHA don't even offer them. So that's the main reason why they're like unicorns out there. Every bank should have them. You do need a big chunk down for them. National Bank of Arizona, Zion's National Bank, they have a good portfolio of them. They're out there. You just have to go to the local banks. And I highly recommend a bank that is local to where the land is located. That makes a big difference. Hopefully that answered your question.
Yeah, I'm writing all those down right now.
Yeah.
What you told me.
Yeah, I mean, that's why you call now I could broker them, but it makes no sense because I'll have to charge a fee for me and they're going to charge their fee, and then it's third party through somebody. And I would rather them go directly to the source for those. So it's a lot better for the end consumer, for the buyer.
Makes sense. Appreciate it.
Yeah, not a problem. Because they're just a different type of a product, because they're not Fannie, Freddie, Ginnie, or they're not offered. All right, I'm gonna stay on here for longer, guys. Did you like that, the anthill analogy? Was it too cheesy?
No, in a way, it kind of makes sense because we are getting a lot of buyers that are asking for things like extra rooms for home offices, and they're, at least in my experience, what we're finding is they're leaving New York, Chicago. They don't have to be there. They can have their kids in Flagstaff schools. They can drive in Flagstaff traffic and then commute to Chicago 3 times a year for any meetings that they have to actually be present at. I mean, that
Yeah.
doesn't work for the service industry. It does work somewhat for the government.
Mhm.
We're finding a lot of local government employees that are working from home. They just link their computers, and you call them to, ask a zoning question, and you're talking to somebody from P&Z or community development at home in their jammies talking to us.
Yeah, absolutely. I mean, look at Chick-fil-A. Their drive-through is now video with people working from home.
Yeah,
I mean, the world has adapted in a way that is changing how real estate is looked at. So, I mean, I have a lot of people that are, I would say the percentage of people working from home is up probably 50%. It's really high. And most of the applications I take, occupancy is a big factor. So we have to verify that they are able to work from home. Let's just say they're employers in Flagstaff, but they're trying to buy a home as a primary residence in Prescott. Well, that sounds like it's going to be a second home. If your job is in Flagstaff, now all we need is a letter of explanation from the HR saying that they can work remotely, and it's not a big deal anymore. Before, it was heavily vetted, they dug into it, and it became an occupancy like nightmare trying to get that approved. Now it's like
standard practice. Yeah.
absolutely standard practice. Yeah.
And it's actually, from what I'm understanding, in the big cities, it's beneficial for the corporations because they can downsize or sublease a lot of their brick and mortar space, and because they don't need to, and then just rent a big hall, twice a year for, if they need big sales meetings or whatever.
Yeah. And it's weird. They're still making the same amount of money. The company is.
Yeah.
Having their people work from home. So their income is still strong enough to support leasing these areas out. My question, that's why you see a lot of these retail areas like kind of ghost towns, but they're still there. The companies are still paying the cost of upkeep because their overall income is still the same. Now, what will be interesting is when these leases or when they do start to expire, how many will renew or downsize, like you say. So the commercial space on the lease, I think, is going to be interesting because of this change in philosophy and how people are working remotely. It'll be interesting to see how that morphs, because the one thing good about capitalism, people figure out ways of making things work and that benefit everybody because they have to. They're forced into it. So we'll see what happens.
All righty. Well, I'm going to step off too. I've got some calls to make, but
You got it.
and
Pleasure talking with you.
yeah, we'll talk to you soon.
You got it. Have a wonderful day.
You, Christy, take care. Thank you.
Thanks, guys.
I have a question, Sean. Vicky Gorman, Realty Executives.
Yes, Vicky, how are you?
Good, good, good. So good. Love your everything. Love everything. Question, I know you think we're just going to have an uptick in the market for Q3, 4, or really Q4. Do you still see that?
An uptick in the market in regards to what aspect?
Sorry, for
Like buyers?
just real estate sales in general in Phoenix Metro.
I think it's going to stay strong. I think you're going to
Okay.
see a rotation in the overall buyer pool as far as who's buying. I think the luxury may slow down a little bit. I think the first-time home buyers will try to pick up a little bit to try to get back into that those lower end sweet spots and replace maybe some of the initial push with people that had a lot of money. But I just think it's going to look different, but I think it's going to be strong. I think you're still going to see homes selling quickly. Instead of 20 offers, you may get 4, you may get 5, or maybe it'll go back to normal and you can actually have 1 or 2 offers that come in a week's time. Wouldn't that be just interesting?
Yeah.
But I think the amount of closings that you'll have, I think the amount of overall volume that will go through our system will be similar, if that makes sense.
Yeah, that makes sense.
Yeah.
What about any, I always ask this because I have them. Just asking, any sunshine light for my FHA buyers?
Yes, but they'll need their patience. So
Yeah, okay.
because they're still going up against these institutional buyers that are putting 50% down, 25% down, or even cash. A lot of them are just cash buyers, but these REITs are buying up a lot of cash. You can't compete. An FHA person can't compete unless they're offering more and waiving appraisals and everything else. Bottom line does make an impact for a seller. So as long as you can make the bottom line better, then your FHA has a chance. But while we're seeing properties appreciate so much and going so high over asking, it's going to be difficult for FHA because the sellers aren't going to be as apt to take an offer over asking if there's going to be appraisal issues with an FHA buyer that may not have the capital to bridge that gap.
You got it. We're just asking.
Yeah.
I knew the answer. I just wanted to maybe hear
Yeah.
a glimmer. Okay.
No, I mean,
thanks, Sean.
that's the second wave that I'm talking about. All of
Yeah.
those buyers that can't buy right now, they want to, they're pre-approved, they're ready to go. They're getting buyers fatigue.
Yeah.
So we just need to keep the oxygen on them and keep them going, keep the IV in them, so to speak, so that they don't just fall out of the whole buyer pool. But that we just need to make sure we're not forgetting about them. Now, even if properties go up 5% with rates still being low, it's still better. I mean, that's where the buy versus rent projections or buy versus rent calculators that I have can help, because you can say, listen, I know you're beaten up a little bit, but even if they go up 5%, let's just say this house is this, with this payment, you're still better off than renting.
I hear you. I use that bid over ask all the time with my buyers. All my FHAs are in your basket. So
Yeah,
I'm just asking.
we'll stay close to we'll still stay close
I know.
and
Thanks,
make sure that, yeah, anytime.
Hey, Sean,
Yes.
I had a quick question in regards to trying to bridge that gap on the appraisal. And we talked a little bit about it before, but if you can refresh just the language I can use. So if they were at 20% down, but now to bridge the gap on the appraisal to bring that back up. And then if they go to 15% down, how can I talk them through that with the agent in the sense that, you're going to get the house, A, that's your choice, but B, what does that really look like from a number standpoint? It's not so difficult or, punitive as it used to be. You know what I'm trying to say?
Got it. So for the seller's aspect, nothing's going to change. It's just the loan amount or the money out of pocket is going to be a little bit different. Excuse me, for the buyer. So the sellers don't really care as long as you tell them it doesn't matter what it appraises for, we're still going to buy it. Or you can have verbiage on there showing, we're willing to go 20,000 over asking, but that's the max. You can do, I've seen a lot of people put caps on how much they're willing to go above, or but again, if they need an appraisal and they're waiving the appraisal contingency and there's enough room in there, I mean, you can do 20% down and go into it, and then the appraisal comes in all wonky, and we may have to lower it so that the same amount of pocket being used means, 50,000 is now being brought in above what it appraised for. So if the total money that they were doing before was 80,000 down, now they're setting 50,000 above ask, and now they only have 30,000 left over for the down payment based on the appraised value. And that's where they would have mortgage insurance, because we always base the loan on the value of the property on the appraisal. And if they need that extra money to go, let's just use a real numbers. Let's just say purchase price was 500 and they were putting 20% down. So 20% down, they're putting $100,000 down. Appraisal comes in at 450. So what we do now is that we say, okay, we have to base the loan on 450. So we need to allocate that $50,000 to bridge the gap. So that money is spent. Now we have 50,000 left. So at 450, 50,000 is just a little bit over 10% down. So that mortgage now requires some form of mortgage insurance. Now they still have the same money out of pocket. They're still buying it for the contract price of 500, but that low appraisal kind of messes things up for the buyer as far as how they're strategically putting together the mortgage. We can also do a first and a second. We can finance that and avoid the mortgage insurance by doing a first and a second. We can buy out the mortgage insurance and still do it with 10% down with no mortgage insurance. You can have it built into the rate, have the mortgage insurance built into the rate as well. And that's another way of getting around that. So it becomes more of a strategy on how to do that based on kind of the overall comfort level of the buyer. But when you have, here's an example that we did. We had a transaction come in, the appraisal was significantly lower, like significantly lower than the actual purchase price. So I had the idea of, well, it's kind of a shock to the seller as well. They had no clue. And we asked the seller, we told the seller, yeah, it came in really low, but we still want to buy it. But we're going to ask you, can you give us a credit of $3,800, I think is what it was, towards buying out, paying for the mortgage insurance. So there wasn't a renegotiation on the price. The sellers agreed to buy out the mortgage insurance so that the loan terms or the payment didn't change for the buyer. So that was a unique way of doing it. It really just depends on the buyers. Now, in that particular circumstance, we knew that there was other properties that were under contract and they were going to be closing for a price that supports what are sold for. So the buyer was comfortable knowing the value was there, just appraisal, nothing had closed yet. So we couldn't use those comps. So it really just depends on each individual buyer. I hope
Thank
that
you.
answered. Did that answer your question? Here's a
Yeah,
long-winded,
sure.
but if you have a specific one, we can talk about it, but or anything more, any specific verbiage you need, I can help you with that as well. All right, let's see here. Thank you. Oh, my pleasure, my pleasure. Perfect. All right. All right, well, I'm gonna stay on a little bit longer. If you guys have any questions? And have a wonderful, wonderful week. Hey, John, it looks like I missed your phone call.
Yeah, I had to jump off for a little bit to take a meeting here,
Got it.
and I was bummed because I really wanted to hear what you had to say about the mortgage forbearance.
Got it. So
I don't mean to have you repeat your class. I mean, I could watch the video if you send me a link, or if you can
No, I
sum
can
it
go-
up real quick, that'd be cool too.
yeah, I'll give you a quick sum up. Essentially, FHA put an announcement out Friday that basically said they're going to postpone the elimination of the forbearance opportunities until September, so end of September. So that's FHA. Conventional still hasn't followed anyone yet, but the conventional is supposed to end at the end of this month. So what that basically means is lenders can start actually posting that these customers are late into the notice of default bucket with public record. And they can start the foreclosure process if they're in that. Now, there's about 1 million homes that are in forbearance right now in the nation. Of that, about 50% of them are already in a payment or a loan modification plan where they've already taken the suspended payments and added it to the back, where it is now a second loan at 0%. Or they're making payments that they missed, but they do owe that money. So most of the lenders, I would say all of them have to, but most of the lenders are doing it that way. They're getting ready for some short sales as well. But if all of the homes that are in forbearance right now that are not on a plan, let's just say 500,000, if all of them hit, it's projected that'll add 24 days of inventory to our market. That's not very much. That's not very much at all.
No, I was thinking it would have been a little bit bigger of a bump there on our inventory.
Yeah, it's going to be a bump. You'll see more. But I mean, it's going to be a slow trickle, and but you will see it. I promise you that inventory will increase, but the amount of buyers that are out there is so much higher than the amount of listings. I mean, you've probably seen it. You've probably seen 10 to 15 offers on properties between the 300 and 600 range that are good properties. Those are buyers that want homes. So that's, what is that? If you just take the formula, this might not be a good ratio, but the number of buyers per home per offer, there's 20 buyers for every home, or maybe 10 buyers for every home that's out there. So we would really be able to, let's just cut that in half. We could have 5 times the amount of homes on the market right now and still absorb that pretty quickly.
Okay. Yeah, I was looking at the inventory this morning, and the active listings, we're only at what, 6,700 active listings in the. So yeah, I imagine that even if we do get a shot of inventory from the forbearance, we probably get back closer to a median, you know, like a medium level inventory for this time.
Yeah. Yeah, I mean, even if we got, so we're 30, I think it's like 35% lower than our normal for listings, for our market for inventory. And we could literally triple our inventory to handle the buyer demand. And you guys would just be doing a lot more closings, and you'd be working with a lot more buyers, and they would be absorbed real quick. And don't forget, all those institutional investors are buying. Did you hear those numbers?
No, I didn't.
So institutional investors like BlackRock, corporations, REITs, all of these major holders and buyers of real estate that are at the institutional level, they, in the last quarter, in quarter two, Q2 of 2021, bought 67,943 homes. And they're turning them into rentals. In quarter one, they bought 59,000 homes. Builders are now building homes and turning them into rentals. And when I say builders, I mean like T.W. Lewis, D.R. Horton, I mean, builders like that.
Yeah, I think Christopher Todd is doing that too.
Yeah, they're a bit, yeah, exactly. So you're seeing that pop up across the nation because they see, well, if I sell them, I'm making a commission and the profit on it. But what if I hold them and rent? The rents are so high right now, we'll make a major profit, hold it for 10 years and then sell it. We're going to be in a much better position. So it's really interesting. A lot of big money. There's a lot of big money out there. There's a lot of capital out there in the markets. That's why they can sit on it, because they have assets. They have a lot of assets. They don't need to sell to keep funneling their future projects. So they're renting, and that cash flow is kind of fueling their overall spending, so to speak. But yeah, it's crazy. Builders are actually slowing down as well. This month, the builder, here's the numbers. The new home sales, which measures the number of newly constructed homes with a committed sale during the month of June, have actually decreased by 6.6%. And there's quite a few builders that are slowing down because they're selling too many homes and they can't build them fast enough. So they're just slowing down the sale. They're just not selling them. It's crazy. So that's not what we need. We need more.
Yeah, and any predictions for when FHA stops kicking the can down the road?
And I think they'd want to see the percentage of people that's, I think 10% of FHA 10% of FHA's portfolio was in forbearance, which is higher than they want. So I think they want that number to come down and kind of clean it up first and get people back on track. Because that market, that lower income market is very important to the health of the nation. So they want to make sure that that is propped up a little bit more, I think, before they cut loose, so to speak.
Cool. Well, thanks, Sean, for taking the time to recap that with me.
Yeah, my pleasure. Hey, Wayne. Hey, Marianne. You come in a little bit late, guys. Did you miss anything? You have any questions?
Oh,
Did you just hop on right now, Marianne?
yes.
Got it. Got it. So I did record this. I'm going to send it out to everybody. But we basically went over the forbearance, what's happening, what the predictions are, how much it'll impact our markets, kind of what we can do to position ourselves to market to them in a more efficient way. So I'll send you the link to the Zoom that you can hop in. But any questions that you may now have that I can answer for you in the next 10 minutes? Because I can stick on for a little while.
Not me.
Okay. Perfect. Susan, Wayne, Brandon, you guys still there? All right, well, I am going to end the session and thank you all for everything. If you do have any questions, you can always shoot me a text, give me a call, and we will be in touch. Have a great day, guys. See ya.